Hello everybody. So this video is entitled HIMS Stock, a Blowout Q2. This was really an outstanding Q2 for the long-term investor. We got everything we wanted as long-term investor, even a timeline when it comes to peptides, and we got some guidance for 2026, and we got revenue growth in droves. Revenue growth is doing better than most people would have bet a year ago. But Wall Street hates it because gross margin is down, I suppose. That really doesn't matter to the long-term investor. Gross margin will stabilize. Also, the headline numbers on GAAP is negative year over year, but quarter over quarter it got better. And of course it is. You know, HIMS is an investing year. It's adjusted EBITDA is what matters to me. I compare all of my stocks based on adjusted EBITDA, and adjusted EBITDA took a little hit, but it's just doing fine considering how much HIMS is investing in its future and in its growth. So to me, everything to love. To Wall Street, it's down 7-8% in pre-market. I wouldn't be surprised if this ended up green at the end of a week, or if even today. I wouldn't be surprised with that. The move actually on HIMS stock, I'll get to that chart in a second, the move was actually much lower than anticipated, right? Options were saying we should have moved something like 15-20%, not this little. So anyways, let's talk about what's to love. What's to love, I love when they start. And of course, we knew this before, right? They've had this slide before, but when they start their long-term vision of serving 100 million customers in the world, across the world, and that's just looking at the total addressable market. You just add up the USA and Europe, you capture a smaller portion of that. Still a big company, still a big tech scale type of company, but you don't capture every customer in there, and you could get to 100 million customers. So there is a very long-term growth runway. That's why to me this is a 10-year hold. I want to hold this stock for a very long term. There is a path to potentially growing the size of HIMS by 33 times. And that's literally the first slide. And I think that's the slide that we should all remember, is they grew by 300,000 subscribers this quarter. Of course, that's thanks to the acquisition of Eucalyptus. But the base is now nearly 3 million people on which they can unleash AI to learn recommendations for what medications work and what medications don't work. And the AI can train on these people. This is extremely valuable, not priced into the stock. Right? It's, Amazon recommender system or Netflix recommender system. Why is Netflix so addictive? Why is Amazon so good at selling you stuff you may not need? It's because they have a recommender system training on all of the data, right? And HIMS has this integrated data set of 3 million customers scaling very fast at more than 30% a year. So that's very valuable. And I like that they talked about AI a lot, actually, in this earnings call and in this quarter. We'll talk about AI in a little bit. More short term, where is the growth going to come from? Well, first of all, some could argue that the weight loss segment alone could provide years and years of growth runway for HIMS, and I definitely believe that. But there's other things that are scaling. Of course, testosterone is scaling really fast. When they started launching that last year, people were excited about menopause, but it was actually testosterone that was the bigger market. And of course, you can do more cross-selling with HIMS, obviously, because HIMS is still the bigger business. So they can do a lot of cross-sell. They have a lot of customers in their late 40s, early 50s who go and take the labs. And you take the labs, and then you find out that, hey, you're eligible for this testosterone treatment. They're going to sell these a lot because these testosterone treatments are not that easy to get in the real world. You got to have many doctor visits in the traditional health sector. And that's a big deal. And that's the second fastest scaling specialty for them outside of weight loss. And that's fairly new. They launched last year, well, less than a year ago, right? They launched 11 months ago. So that's a big deal. And then the bigger deal that we got, of course, is peptides coming soon, awaiting final rulemaking. And so if the rulemaking is coming up, maybe in the fall, you could potentially expect, I would expect perhaps a launch in the fall for peptides. And that includes the big peptides, right? Including BPC 157, including TB500. Like a lot of big peptides were reviewed in that first round. And I mean, BPC 157 could itself be very big for HIMSS, and they could sell it. And they're building that best-in-class peptide experience. And remember, they bought the CS Bio manufacturing facility for peptides. I did some research on Google Maps a few months back, actually looking. They bought the entire manufacturing facility. They can make their own peptides. This is a major differentiator. Most of the peptides today come from China. And HIMSS is going to be making them in the USA. That's going to be a big deal, especially depending on how the rulemaking is made. And so I think the peptide, of course, is the next narrative for HIMSS stock. Right now, the revenue, the money right now is coming from the weight loss drugs. And remember, of course, they are charging less than they used to charge for weight loss, but they are now charging $149 a month for doctor visits and follow-ups. And so they're going to make a lot of money from that fee. That fee is all theirs to keep. All right, some people argue and complain, and they say, they're just really feed through, especially for Eli Lilly. They're not really a partner. They're more like feeding through the order, through their pharmacy. Sure, but they're still earning $149 a month for that fee, that weight loss advice, that weight loss tracking. They introduced that scale. So in my view, much of the money now is going to come from weight loss drugs, right, from GLP1s, and then the next avenue for growth is peptides, and the stealth one that we forgot about is TRT, hormone replacement, especially testosterone. That's going to be a big deal for HIMSS. If you go to any strip mall in America, you see there's a lot of quote unquote low T store Andro X, or I don't know what name there is, but so many strip malls in America have that. And so that's going to be a big deal. Anyways, let's look at the prior year-over-year growth. Again, this is important to remember. I need to go back to these videos, go back on these comments. I remember last year when I was covering this stock, many people were telling me, there's going to be no growth anymore. The growth is going to be dead. All of the growth was coming from GLP1s. GLP1s, compounding is going to be banned. They're not going to be able to pivot to branded, and the growth is going to be dead. Well, I'm pleased to say that it didn't happen. The growth definitely didn't happen. We're looking at revenue growth, year-over-year revenue growth from Q2 of last year to Q2 of this year, right? Plus 38% revenue growth. That is not the end of growth for this company. And you know what? If they had ended growth and they had stopped marketing spend, you would have just had one of the most profitable companies out there anyways, because the growth at HIMSS is subscription. They're subscription businesses. Yemi said many times on the call, they still have customers from 7 years ago who still keep their original ED subscription. It's a long-term business. Once you're in, once you have your subscription, you are less likely to stop. You're likely to continue. They don't have to fight for selling the drugs or selling the doctor visit like the mom and pop doctors or the mom and pop pharmacy. Pharmacies have to fight every time to get the subscription sent to them. They have to fight for every sale. Mom and pop doctor, local clinic, they have to fight for every visit. It's not the case for HIMSS. They don't have to do that because it's on autopilot. It's the same as a SaaS business. It's really amazing if you ask me. And of course, the revenue growth can be explained by two factors. The average mix, right? The sales mix is higher, and that's thanks to GLP1s. GLP1s are still more expensive, especially the follow-ups. But we also had a growth in subscriptions. So much of the growth doesn't only come from increasing prices, it also comes from more subscribers coming in. And when you multiply the two, that's when you can get some exponential growth, to some level of exponential growth. If I look at international sales 17x, and of course that's thanks to acquisitions. And the acquisitions have been doing very well on HIMSS. And HIMSS and Wall Street will complain on the fact that international growth is mostly because of acquisitions. But there's a few things we need to say about acquisitions. Wall Street's reluctance or big fear of acquisition has to do with big acquisitions, mostly big acquisitions. Case in point, look at the AT&T's acquisition of Time Warner, of Warner Brothers, or whatever it was called. Right, $80 billion acquisition. Wall Street typically, and I think if they are right, Wall Street is right to be wary of very large acquisitions. But these were relatively small acquisitions for HIMSS. Not that big of acquisitions. Eucalyptus was the biggest, but even then, if you look at Eucalyptus, they definitely got it on the cheap. You may remember me having made a video back then. Turns out HIMSS valuation back then was low, and HIMSS valuation I've always found very, very low. But turns out Eucalyptus in the private market was trading even more dirt cheap, and they got a big share of seller financing for eucalyptus, by the way. And frankly, the way they've handled their acquisitions to me has been astute. There is no other way to say it. Why do I say they've been astute? Because if you look at the converts, I mean, the conversion for the first convert is roughly the stock price that we have right now, by the way, something like $29. But if you look, their 2030 converts, 0%. And they have another tranche of 2032 converts still at 0%. They are borrowing money at 0% for a conversion price, which is roughly the price that we have today. But that dilution we only see, 4 years from now. To me, this is astute fundraising. This reminds me of, of course, not a lot of people follow MSTR, but if you follow MSTR, the early deals that MSTR made in their convert financing, that's free money. I mean, it's very, very cheap. It's very, very, very cheap, and the dilution is far down the road. So I'm not really worried about that. They could have financed with dilution. Right, that would have been worse for the stock price, wouldn't have had it. So I like their corporate strategy. I think they've had good acquisition strategy. Again, these are small companies. As long as they are small companies, I'm fine to see that. Moving on, let's talk about the forward growth. The forward growth, as you can see, this is their updated guidance between 32 and 41%. So the growth has not abated. The growth is still being guided in the 30 to 40% range, and they have a history of sandbagging. So in my view, it could be 40% in 2026 because they have this history of sandbagging. Now, if you look at their adjusted EBITDA is actually going up compared to Q1 2026, which was a big investment year for them. But it's 8% adjusted EBITDA margin. We were bigger last year, mostly because of the compounded GLP1s. You made a little more money, but it's still going up in the second quarter, and in my view, eventually this will stabilize in a higher EBITDA margin number. Hopefully 30%, like they've said before. Hopefully down the road in the 2030s and beyond, we can get to 30% adjusted EBITDA margin. That would be an amazing business. Absolutely, absolutely amazing business. Now, if you look at the proper guidance, of course, between 32 and 41%. Now, what number am I going to use in my valuation? So let me update my valuation here. I'm using trailing 12 months for revenue, so that's 2.57 billion. I'm using 37%, so I only increased my revenue growth number to 37%. And for the sake of simplicity, I took the 2026 guidance. Now, I'm fully aware that there are only 2 quarters left, but I have to assume that the growth in 27 will be stellar, considering testosterone and considering peptides. So to me, 37% revenue growth next 12 months is a fair number because it's partially guided in there, and the first 2 quarters of 2026, I can only assume they're going to be good, especially if we launch peptides. So anyways, I find this quite appealing. The valuation, it's very funny. HIMSS is consistently cheap. Even with HIMSS trading down 7%, minus 7% in after hours, we're trading at 29.50. 29.50 HIMSS is trading at. The valuation is still a 0.11. So the stock remains consistently cheap. Like, it's still cheap. I adjusted all of the numbers. It's the same level of cheap, despite having dropped this much. Rule of 40 dropped just a tad, just a little bit at 46%. And I'm using 9% EBITDA margin. I should really be using a little higher because I think they're going to improve that. Gross margin, I'm using 69%. The reason why I'm using that is because I'm taking 4 quarters of gross margin averaged. Now, is the gross margin going forward going to be 65%? I don't think so. I think they'll get a handle on that gross margin going forward, especially as some of the other mix, right? The revenue mixing, including testosterone and peptides, should provide higher margins than pure GLP-1. Also, don't forget, because they are growing GLP-1 right now, they have all of these ads going on. They have all of these sales, first month, $39, or first 3 months at $49. They do all of these sales consistently to get customers in through the door for the first few months. So that's also one of the reasons why the gross margin went down is they've had sell prices on these GLP-1s. So I'm not too worried. The valuation is still dirt cheap. The stock is still dirt cheap. Now, again, I've discussed gross margin. Another thing to discuss, of course, is the GAAP loss. 86 million. There's a few things to look at. First of all, that GAAP loss wouldn't have been nearly as high if we didn't have contingency accruals related to the recent liquidation. And if you look, again, this is where it comes from thinking for yourself and not letting an accounting body, GAAP, right? Well, generally accepted accounting principles, but not letting the big accounting body of the United States decide for you the value of your companies. When I look at of course, net loss, right? 86 million. Well, we gotta add a lot of stuff that really doesn't have a cash weight. Stock-based comp. Why do I love stock-based comp so much? Because if we didn't have stock-based comp, we would have had to have $42 million of cash drained from the balance sheet, and we only have $700 million of cash. How much cash do we have? We have $840 million. We only have $840 million. So if we didn't have stock-based comp, we would have had to pay out $42 million worth of cash. I much prefer a little dilution to pay my execs, right? Depreciation and amortization. I mean, I will stand on that hill. It's a phantom expense. It is a phantom expense. Most depreciation schedules go much faster than whatever equipment you're using. Whatever, my favorite example is commercial real estate. Commercial real estate can last 100 years. You depreciate it over 27. Yeah, you got your depreciation down to 0. Guess what? It's year 50. You're still using it. So anyways, when I look at all of these expenses that you add back, then you get to a nice adjusted EBITDA, positive adjusted EBITDA. I much prefer that. As you know on this channel, I also fundamentally disagree on how accounting rules account for marketing spend. In my view, marketing spend is an investment in the future, especially when it comes to HIMSS. And you know what? Anything below gross profit and operating profit, that line, I mean, except SG&A, sure, SG&A I agree, but that line, AI, investment in AI, right? Is that a cost? Is that an investment? No, it's an investment to me. Investment in marketing. In the case of HIMSS, it's a major investment in marketing. They're having enormous ROI on marketing. If you look at their marketing efficiency is actually getting better. We're down to 6 months. We're up to like was it 7, 8 months? We're back down to 6 months. The payback period is now higher. They've done better at marketing spend, and of course they are doing better at marketing spend. Why is marketing spend getting better for HIMSS? Because they advertise on national channels like national television, TV shows, etc. And now that they are well known, they can target many more people. So the cost per ad goes down as you can target the entire country, because you can serve the entire country. So you can target everybody all at once. Many companies cannot achieve the marketing efficiency that HIMSS achieves, right? That's why HIMSS finds it valuable to advertise in the Super Bowl, because you have enormous marketing efficiency, but you need to get to a level of scale. So I like that they invest in marketing. I like that they invest in themselves. They also have a little bit of a buyback in place. They barely used that buyback, by the way, and I think that's a good thing. I think they have so much more money to be made by actually investing in the future, and they invest in their brands. And of course, we know HIMSS is a customer-centric company. They have the best brands. They're very good at branding, right? Look up my videos on Hard Mints by HIMSS. Excellent branding, removing the stigma, much better branding than the blue pill, if you ask me. But they do the branding all over. They have their own branding. They invest in so many different things, including personalization, including data, including AI. On the call, they mentioned they were going to ramp up their AI buys and their AI investments, and the use of AI chatbots, and in their conversations, whenever you have a question, etc., use an AI chatbot to gatekeep the expensive doctor. So they're moving towards that AI doctor vision, and that AI doctor vision is coming sooner than we think. Of course, there are still state-by-state regulation, but if you look, I think at developments in the state of Utah, I think, was it Utah or Wyoming? One of these two states was very forward-looking when it comes to AI doctors becoming a thing. I think that this will be a very big debate, and at one point, people will prefer AI doctors. And what company will be the best to provide that? I think it will be HIMSS. And then AI designed drugs. And then AI customized drugs. It's the AI who customizes the drug for you, because you have 3 million people and a recommender system on top, and you can know exactly what works for your profile because they have all of the data. Anyways, I get very excited about the future of this company. To me, this is a no-brainer. This is as much of a no-brainer as you can, and I don't walk you through my usual take on it, which is digital pharmacy and digital doctor and customized drugs all together minus insurance, because make no mistake, the reason why they can move so fast, the reason why they can grow so fast, especially in the US, is because they don't use insurance. That's why they can move so fast. They charge cash. They charge credit card. They don't want your insurance info. They don't wait 6 weeks to get reimbursed. They don't argue with the insurance company, with the pharmacists hired by their insurance company. Did you know a lot of pharmacists actually work for insurance company? They don't have to argue with a pharmacist at the insurance company who says the doctor prescribed the wrong thing and doesn't want to pay. That's why they grow so fast, and I think they'll continue to grow at a pace that is much more consistent with a big tech company. So to me, this is a long-term hold. I love the stock very much. It's down 7%, whatever. For him, this is actually a very small move. This is like Wall Street not reacting much for him. That's what it is. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.